Welcome everybody to this session. If some of the presenters could come up here and sit down, that'd be well appreciated. Okay, well, welcome everybody to this session on lessons and challenges for the profession. Before we get started, I introduce the speakers. We'll have three speakers this morning. Each of them will speak for 20 minutes, and we'll have a 10-minute Q&A after each presentation, and then we'll have a 15-minute Q&A for everybody at the end of the session. Can I encourage you, please, to submit your questions? I know this is a small room, but to keep everything consistent the way the Institute wants it, can I encourage you, please, to submit your questions through the app? Now, I understand it's a little bit confusing. I found it confusing anyway, so I don't know about the rest of you. So you need to have your app. You possibly need to refresh it, because submitting the questions will be through the Now On bit of the menu under the app, and that kind of needs to be constantly refreshed so that the Now On is what's now on and what was on last time or yesterday or whatever. So you need to refresh that, and can I please ask you then to submit your questions through the app, and they'll come up to me, and then I'll ask the presenters accordingly. So without much ado, our first presentation is on climate solvency. It's by Louise Pryor. Louise is co-chair of the Actuaries Carbon Collaboration, is an actuary who focuses on sustainability. She believes that actuaries can be a force for good in the world, helping to reshape the financial system so that it serves society. Louise is a past chair of the London Climate Change Partnership, a past president of the Institute and Faculty of Actuaries, and current chair of the Ecology Building Society. So can you please welcome Louise?
Thanks, everyone, and it's really great to be here. So this talk is called Climate Solvency, or it could be called Can Actuaries Save the World? The answer to that is no, but we can probably help. I'll just give you a bit of a spoiler. So what I'm going to be talking about is the Actuaries Carbon Collaboration, and I'll start out by talking about what it is, then move on to one of the sort of basic one of the foundations of what we're doing, why greenhouse gas emissions are like cash flows, and that brings us to what actuaries can do, what insights have we gained through our work, and what do we want to achieve. So what is the Actuaries Carbon Collaboration? It's a group of actuaries, clues in the name, thinking about carbon, again, we're not subtle here, working towards a coherent understanding of the issues around carbon emissions and offsets by considering them in an actuarial context. We've got around 15 members. It's very fluid. It's not really a terribly formal group. We've got a website, links on the slide. Our members are very varied. Most of us are actuaries, but we've got a good sprinkling of architects and other construction industry people. We've got young and old actuaries. We find that we're good at different things, so it's great to work together. We've got environmental specialists. So it's all about collaboration, and this is the first point I want to make. Actuaries can't work on their own. There's some things we're very, very good at, but there's a lot of things that other people are very, very good at too. So let's work together. So we now move on to why greenhouse gas emissions are like cash flows. You've got this atmosphere thing, okay, which has got a concentration of carbon in it. And you've got greenhouse emissions going into the atmosphere, adding to the concentration of carbon, and you've got various ways that the carbon is taken out of the atmosphere. You've got, say, an insurer or a pension scheme which has a pot of money. You've got contributions or premiums coming into that pot of money, and you've got benefits payments going out of that pot of money. It shouldn't take an actuary to see the similarities there. What we're trying to do is either keep the pot of money large enough or keep the concentration of carbon low enough. So what we're saying is that we think that there's a lot of commonality here, and this is one of the ways that actuaries can really help. So I'm sure you all know about global net zero, but possibly some of you think that global net zero is a really cool thing and the absolute answer to everything. I'm here to tell you that it's not. Global net zero is probably necessary, but by no means sufficient. It's essentially a flow-based target or a flow-based milestone for a stock-based goal. Our goal in the end is to keep the stock of carbon in the atmosphere low enough. Net zero is a flow-based milestone. And how it was derived originally, right, this is where I show how useless I am at operating technology, but let's have a go. These are all possible pathways towards reasonable climate outcomes. And the people who came up with net zero said, well, look, what we want is we want a pathway that keeps us reasonable without too much overshoot. And they plotted all these pathways out, which is great. We're actuaries, we don't like single projections. We like to know what the range of possibilities is, so this is great. And they saw that most of the good ones, or many of the good ones, happen to go through zero emissions in around 2050. So they said, let's set that as our goal. So we can see that it's going to be a good thing if we get to net zero in 2050, but it by no means guarantees that we avoid climate catastrophe. So that's the first actuarial insight, and I claim it as an actuarial insight, but actually there's an awful lot of people who know about this and who aren't actuaries, but I've tried to present it here in an actuarial way. But this is really important, because what we're trying to do is, remember, we're trying to keep the carbon concentration low enough in the atmosphere. And one way we can think about that is by thinking about, well, how much carbon can we emit into the atmosphere? And this brings us to the concept of carbon budget. This slide's a couple of years out of date now. These numbers are going to have changed. But the point is, if we keep on emitting, we're going to run out of budget very, very soon. If you keep spending out of your insurer or your pension scheme, you're going to run out of money very, very soon. You have to think about how much you can take out before you go bust. We have to think about how much carbon we can put into the atmosphere before we run into climate catastrophe. And the answer is not very much compared to the amount we have put in over the last couple of 100 years, but especially over the last 40 or 50 years. An enormous amount has gone in just over the last 40 or 50 years, and if we keep emitting at our current rates, climate catastrophe is pretty much inevitable. So, the first sort of major actuarial, first, I think, actuarial insight that really hits home is let's think of this in terms of solvency. Let's call it carbon solvency. Carbon solvency is keeping the concentration in the atmosphere low enough. Okay, it's slightly different from keeping your levels of capital high enough, but I'm sure you'll agree that the principle is the same. We've got essentially asset and liability cash flows, things going into and out of the atmosphere. We're actuaries. We don't plan on what we think will happen, a single expected outcome. We think in terms of probabilities. In terms of insurer solvency, we think very much in terms of probabilities. In Europe, we think about 0.5% a year that we can only have a probability in each year of operation of 0.05%, no, sorry, 0.5%, sorry, I always get, anyway, not very much at all, okay? You really, really don't want your insurer to go bust within the next year. If you multiply that up over 30 years, and I'm being slightly generous here because 2050 is now less than 30 years away, and if you assume that each year's, making quite a lot of assumptions, but basically, if you're an insurance company, you basically operate on the fact that you're going to have around 15%, under 14 or 15% chance of things going horribly wrong within the next 30 years. What we're doing with the world, with our planet, is saying we are having about a 50% probability of things going horribly wrong within the next 30 years. That would be no way to run an insurer. Is it any way to run a planet? The way I'm phrasing this question, I think you can tell what my answer is. I think this is just appalling. I think it's appalling that people aren't thinking in terms of probabilities more. One of the problems is that climate scientists aren't allowed to. The pressure on them is very much to only say things that can be strongly supported. So their whole sort of culture is that they can only say something is going to happen if they're really, really sure it is going to happen. We're actuaries. We look at the range of possibilities, so we should be thinking about what could happen. And what could happen is climate catastrophe within the next 30 years, basically. And this is not a good outcome. So a group of us got together. We sort of played around with these ideas a bit, and what we decided was that we really needed to start thinking about how we can use our actuarial skills in this context. Actuaries are used to thinking about solvency in the context of insurers and pension schemes and so on. How can we apply those skills to this problem, which, to be honest, is much, much more important than insurance company solvency? I know I see some regulators or ex-regulators in the room. We all think that insurance company solvency is important, but actually saving the world is much, much more important.
Oh.
Sorry. If there's no world, there won't be insurers, okay? I mean, let's be honest here. So how can we use some of the skills we have in thinking about cash flows to think about carbon? Are there equivalents of the revenue account and balance sheet? Some of the reasoning we do around that, can we do that in the case of carbon? But especially, how can we use stochastic modeling, think about our risk capital, planning and risk management? How can we do all this in the context of the climate? So, what insights have we had? I think we can put it into 5 categories. We have put out how we operate is we're just a small group, and basically we write papers, we put them on our website. We don't plan particularly. It's what people are interested in, what they can be bothered to write, what they can find collaborators to write on. We keep the papers very short. I think the longest one's probably 6 pages max, because we think it's more important to get stuff out there, to get ideas out there, than to polish it and get it burnished and gold-plated and everything. It's just getting the ideas out there. So, call to arms, collaborations, applying actuarial skills, educational pieces, and prototypes. The call to arms, I'm kind of giving you this all through this talk. We need to do something. Everybody needs to do something. We can step up to the climate emergency. Our skills can be useful. We also have influence. I think we possibly tend to underestimate our influence. We are involved in running insurers. Insurers have huge influence. How can we influence our employers? We can influence our employers both through the work we do, through making sure that we identify the relevant risks in the work we do, but also by talking about it. Ask questions. Ask your boss, have you thought about climate risk in this context? He or she may say no, that's fine. Just ask them next week as well. Eventually, they'll get used to the question and start thinking, maybe there's something there we should be doing. It is time to use our skills. We claim to have skills. Let's use them to do something really, really constructive. But we can't do this on our own. So we collaborate. As I said, we've got a lot of architects in our group. It's an accident of how I came to put the group together, the people I was talking to at the time. Architects have done some fantastic work on whole-of-life carbon in buildings. Really great framework, works really well. Some big problems with it, like they just take all the carbon emissions over whatever timescale they're thinking of, 50 or 100 years, and they add them together. Okay, so you get a single number at the end with no notion of when those carbon emissions are going to happen. This is not how we do it, actuaries. This is not how we do it. So we need to think about what that means. We need to think about whether a single number is the right thing, how that happens. And there are some problems with the framework, a lot of data problems and things, but we're used to that and we can deal with that. But this really brings us on to my next thing, the time value of carbon. It really matters when carbon emissions are. You really, really don't want to emit a lot within the next 5 or 6 years, because that way we'll reach tipping points that you can't come back from, okay? You can't emit zillions of tons now and say, oh, but it's all okay because we'll absorb zillions of tons in 20 years' time. Because by that stage, it's going to be too late. We're going to be in a situation that we can't get out of. So time is really, really important. So we started doing some thinking about how you should allow for this. And obviously we're actuaries, so we think about discounting and discount rates. But there's some ways that discount rates work that I don't think are really suitable for this. So what I've done, typical, bloody typical, I've identified a problem without coming up with an answer. But I put that out there as a problem that we need to think about, and I think we'd be good at thinking about it. And now I'm just about to finish as immediate past president of the IFOA. I am, fingers crossed, going to have a lot more time to think about it. So we shall see. We've also had a great work being done using a Markov model to simulate where we could end up by 2100, look and see what's happening in the world, how consistent is that with the various scenarios, and think of ourselves as popping in and out of various states. And we've also just written a paper on thinking about fairness when allocating the carbon budget. Actuaries say they think about fairness in the context of with-profits insurance, in the context of pension schemes and so on. Can we apply those techniques there? And the answer is kind of, sort of, but actually we need to think about it a lot more carefully. And that may mean that we need to think about fairness in those other contexts more carefully too. But go and read the paper. We've written some basic sort of informational papers, carbon credits, how they work, what the concerns are. Trees, what are the problems? There are lots of problems with trees. Trees are not on their own going to save the world. They're jolly good, and we all like them, but it's not good enough. And what does net zero actually mean in practice at various scales? What does it mean for the world? What does it mean for an organization, a company? What might it mean for a product, for example? If you're designing a net zero life insurance product, which you should be, what would that mean? How would you go about that? Something to think about. We've also developed a prototype, where do I have, oh, there we go, a prototype visualization tool to look at carbon emissions so that you could play around with plans, for example, your net zero plan that your organisation undoubtedly has in immense detail, thinking about what your organisation's carbon budget is and how that's going to play out. So we've developed a visualisation tool to look at that, do some stochastic visualisations of this because nothing is certain. We think you can apply it at any level. These are the sorts of things it produces. It's all online. I'm working on it. If anybody who's into Python and so on wants to get involved with that with me, that would also be great. We're trying to basically think about what actuaries do, how we can apply all those different skills to this problem, which is a big and important problem. So, what do we want to achieve? We want to increase the credibility of the actuarial profession in this field. We think that actuaries have a huge amount to offer. We need people to know that we have a huge amount to offer, and we need, if it's sort of building the credibility so that people will come to us. That gives opportunities to actuaries, which is great, but it also gives us opportunities to make change, which in the circumstances is even better. So this is really a thought leadership exercise that we're trying to do. We're trying to get actuaries to think about what influence they have, what levers have actuaries got that they can use, that we can use. We think that actuaries' key strengths are dealing with uncertainty, modelling. I'm a bit dubious about modelling, but at least I'll take visualization of model results as a really good thing that we can do. Data, we do understand data to a certain extent and how to handle it. Collaboration, really, really important. And actuaries, we're nitpickers. We can identify inconsistency, and that's really important too. So the message I want you to take away is actuaries are great. There's a lot we can do. Just think about how you can actually bring your actuariness to bear on this problem. Thank you.
Well, thank you, Louise. I've got a few questions that have come through, but while we're asking those, can you please submit some more? More will be fine. You know, don't feel there's going to be too many. That's fine. So the first question I have, actually, Louise, is what do you think is the most important area of insight that actuaries can contribute to this?
I think it's all around uncertainty. I think it's about trying to get away from the inevitability of you do this and then that is definitely going to be the outcome. You get to net zero and we will definitely get the climate outcome we need. We don't know what's going to happen. We don't know what's going to happen even if we get to net zero by 2050. People need to realize that net zero is not the magic potion that's going to solve everything. We need to do it, don't get me wrong, we need to do it, but it is probably on its own not enough. I've been accused by actuaries in an actuarial meeting of being a doom monger because I say that, you know, I go on about catastrophe and disaster and everything. For heaven's sake, guys, this is what actuaries do. We don't close our eyes to the risks. We identify the risks and we bring other people's attention to them. So that's what actuaries should be doing.
Okay, a follow on kind of from that question. Hang on, it's updated. How do we get the actuarial view on climate change through to major policy setters, for example, politicians and the like?
Yeah. You have to work with them. What we're doing in the UK is we have a really active group of people within the UK's professional body, the Sustainability Board. We respond to government consultations that have anything to do with basically finance and climate change. We've done some work with the Foreign and Commonwealth Office. We did that some years ago, where we were talking about basically thinking about climate change in a risk management context. So we go out and talk to people, and we try and talk to people in a very credible way. So probably not with the passion I'm talking with now, to be fair, but to point out implications, to be very science-based, very data-based, and to point out the possibilities of what might be happening in a very reasoned way. And we don't necessarily argue for specific policies, though we have done that to a certain extent. But it's really talking to people, collaborating with people, make sure that you do work with climate scientists and others to present a unified view that actually makes sense.
Are there any other types of experts that are not currently in your ACC group that you think should be?
Practically anybody.
And you mentioned architects, but
yes.
nobody else.
Yeah, no, I mean, that's a sort of, well, it's not very historical because it's only 2 years, but I mean, that's a sort of historical accident. I think we could do with some more environmental professionals, actually. Possibly some economists. I mean, some of our actuary members would claim that they're good on the economic side.
Well, there's a few here at this conference, aren't there?
Yeah. But possibly some genuine economists. Especially those doing the more interesting work around things like donut economics and some of the other things that are washing around. I think that would be great. I suspect that we would benefit from some PR people. How could we better publicize what we're doing? I mean, publicity matters a lot. I mean, obviously, you've got to have solid stuff to publicize, but how you do it really matters. So pretty much anybody would be helpful at this stage.
Okay. So you mentioned tipping points in your presentation. Can you give a good example of one or more of the tipping points we're close to and what the implications might be if we don't make it?
Ice. Ice is the obvious one. Ice melts. Ice melts and it makes huge changes. It raises the sea level. Ice melting typically makes more ice melt partly because of the albedo effect and partly because just some of the physics of how ice sheets work over bodies of land and so on. Once the ice starts melting, we can't just move a big fridge to the Antarctic, to the Arctic, to the mountain ice sheets. And the Antarctic ice sheet is melting a lot faster than we thought it was right now. And this is a quite actually terrifying tipping point that's approaching fast.
Okay, one last question, and then I'm afraid we're going to have to move on.
Yep.
Sorry about that. Getting to net zero only slows the acceleration of the carbon deficit growth. How do we as actuaries convince the public of the critical need to pay off the carbon deficit, and strong parallels to budget deficits can be seen there as well?
Yep. This is where we need the PR folk to help, isn't it? You know? I wonder if making these parallels that I'm making between carbon emissions and cash flows, it's helpful to us as actuaries. I'm not sure how helpful it is to other people, and that's something we've got to think about. You have to tell stories to communicate, really, to get the message across. You have to tell stories. So we have to come up with a really good but true story of why this needs to happen. And maybe enough people do understand the concept of profit and loss and deficit and so on, that's a story we can use, and we've got to think about that.
Okay. Well, thank you. Can you thank, please, Louise again once more?